What's up, everyone? It's Cowdy with Money Vesting. So 2023 is actually a very special year because it falls on the Benner cycle. I've done a video on this before and on the channel like 3 months ago before 2023 started. I've talked about this, exactly what this is. And in this video, I wanted to once again kind of bring us up to speed on what the Benner cycle is, who Samuel Benner was from back in the 1870s, and also go over some data analysis. In other words, had you pretty much precisely followed that cycle, what the returns would have looked like in the last 99 years when the first buy signal was first produced. So hope you guys enjoyed this video and find it helpful. And the reason I'm doing this video is because I've been seeing a lot of this chart, which you can see in the background, once again surfacing back on Reddit, on Twitter. Lots of people asking questions what this is. So hopefully this helps you out a little bit and definitely is going to spark some interest and curiosity as to what this really is all about. So hope you guys enjoyed this video, find it helpful. If you did, make sure that you drop a like and don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the alerts, binds alerts, options alerts, trade ideas, and of course getting access to all the private videos and lectures. There is a 16% annual discount that does expire at the end of this month. So today we are talking about a farmer based out of Ohio. His name was Samuel Benner, and he was, again, a farmer from the 1800s who wanted to understand how market cycles actually worked. In 1875, he pretty much published a book forecasting business and commodity prices. He identified the years of panic, years of good times, and years of bad times. So that's where this chart pretty much comes in. That's the manuscript, which we are going to break down in a little bit of detail and then jump over to my Excel spreadsheet. But it's broken down into A, B, and C, where A is going to be, again, the times of panic. B is going to be the good times. In other words, the times when you should be selling stocks. And C is going to be the hard times where values of asset prices, everything's going to drop. It's going to be the best time to actually be buying. So once again, panic years, these are years when the market panicked, either buying or selling stock irrationally until the price skyrocketed or plummeted beyond anyone's wildest expectations. So these are panic both ways. Doesn't necessarily mean panic on the downside, but irrational stock buying or stock selling. Good times, Benner represents that identified as times of high prices and the best time to be selling stocks and values and assets of all kinds. And hard times, in these years, Benner recommends buying stocks, goods, and assets and holding them until the boom years of good times and then unload as well. And at the bottom of his card, Benner also wrote a sure thing and save it and watch it closely in the future. As for 100 years, he's been close to perfect as a prosperous Ohio farmer. In the 1873, he was unfortunately wiped out because of the epidemic. And when trying to understand why this happened, Benner discovered the notion of market cycles. And as a farmer, he does focus on iron, pretty much focuses on corn and pig cycles, as well as solar cycles that affect the crop yield, affecting revenue, affecting supply and demand and prices as well. So yes, it is quite interesting. And again, this is the video that I posted again 3 months ago going over that manuscript, and this is the exact thing that you saw in the background before. And periods when to make money. Again, it's been resurfacing on Reddit and Twitter and everything else. So I figured I'd do a video on this once again, going over it, explaining it. So number A is going to be years in which panics have occurred and will occur again. Again, panic can be both irrationally to the upside or to the downside. B is going to be years of good times, high prices, and the time to sell stocks and value of all kinds. And C is going to be years of hard times, low prices, and good time to buy stocks, corner lots, and goods, etc., and hold till the boom reaches the years of good times and then unload. And well, guess what? 2023 is part of that list, and that is going to be C, meaning it is going to be a tough year, it's going to be a hard year, but it is going to be the time to be buying stocks. I, again, talked about it 3 months ago. But, the bottom line is that there is obviously an element of market timing with respect to this, right? So if you can see, 1924 was the first buy signal, and the numbers that you see, 7, 11, 9, 7, these are the corn and pig cycles that do affect the crop yields, the supply and the demand, and of course all the prices, as well as the solar cycle as well that happens every 11 years. So what you're really seeing is the difference between those cycles. The years are the difference between those cycles. So 1924 plus 7 equals 1931. 1931 plus 11 equals 1942. 1942 plus 9 equals 1951, so on and so forth. So these numbers at the bottom pretty much are the C differences between C years. the numbers over here, which is 2 and 5 and 4 and 7, 3 and 6, the numbers you see is the difference between the bottom number, which is C, and B. So for example, 1924 plus 2 is 1926, right? And similarly, 1926 plus 5, which is over here, is equal to 1931. And again, you can kind of go through that again. 1931 plus 4, which is over here, equals 1935. 1935 plus 7 equals 1942. So that's pretty much, and again, you can kind of combine those two numbers. So 2 plus 5 equals 7. 4 plus 7 equals 11. 3 plus 6 equals 9. 2 plus 5 equals 7. So, that bottom number is both the difference between the C years, but also is kind of going over these two numbers in the middle. And the numbers over here, 8, 9, 10, 8, 9. So these are, again, the numbers, the difference between B years. And then finally, we got the bigger numbers, which are the panic cycles, 18, 20, 16. These are the differences between the A years, which is the panic years. Now, I put this all into a spreadsheet because you guys know me. I like to work with spreadsheets. I want to see the data in front of me, like in a very good format. So what I've done over here is that I have taken into account all the buy years as represented by that Benner cycle, all the sell years, right? And then all the panic years. And what I've done is that if you simply bought at the beginning of this year, when the signal first came on, the buy year, and you sold at the sell year, what that percentage return would have looked like. And had you held on till the panic year, what those returns would have looked like. So the bottom line is, if you, let's start from the beginning. And I've also got an opportunity cost, right? The time that you're not in the market, you're sitting out. What is that opportunity cost? I've kind of accounted for that as well. I pretty much went back to the S&P 500, looked at 1920s data. So again, kind of compiled that all together. So again, if you're enjoying this video and find it helpful, make sure that you drop a like and really subscribe to the channel. I would really appreciate that. So 1924, first buy signal. Had you held it till 1926, that would have been a nice 67% return. But holding it till 1927 would have yielded you 110% return, and holding it till 1929 would have been almost a 300% return. So this is not perfect. By no means, this is supposed to be followed, year by year and to be precisely, because it's just another macroeconomic indicator, and it's not precise, it's not perfect, but yes, it would have gotten you out a couple times in some very severe markets, which I'll go over in just a minute. But once again, if you invested in, let's say 1931, that was the next buy year, and sold at 1935, you would have actually lost money, 17%. And not only that, there was no panic year in during that time. So another thing that I want to point out is that since you are, let's say, selling in 1926 and 1927, like around that time, and then we're not investing back in until 1931, what is that opportunity cost, right? What am I missing out on in the markets if I'm just simply sitting out? And that opportunity cost in the market was only -2%. So it's not like you missed a lot of gains. In fact, the markets just were slightly cheaper than when you got out, so -2%. And again, 1931 selling years, 1935, 17% return, pretty much on the downside. That's the only negative return that I was able to find if you followed this cycle, which is quite crazy. If you invested in 1942, let's say that we decided to buy back in 1942, and then we sold in 1945, that would have been 100% return. That was also a panic year, 1945, as you can come back and see 1945 and 1945, both of them, both B and A are 1945, and that would have been 100% return. So we would have doubled our money in 3 years by being invested in the markets during that time. And then buying back in 1951, so from selling 1945 and then buying back into 1951, that would have been a 12% opportunity cost. So this is good, right? I mean, 12% you're giving up for not being invested for a good 6 years in the market is not bad. 12% is the only opportunity cost kind of giving up. And once again, you invest in 1951, get out at 1953, 33% gain, and then get back into 1958, 5 years later. And the opportunity cost this time, though, is pretty substantial. It's 61%, right? So what does that mean? That simply means that if we would have gotten out of the market in 1953 because there was a sell signal, it was in the Benner cycle, and then we didn't get back into the market until 1958, we would have given up 61% of the gain because the market moved up. So buying at 1958, selling in 1962, that's a 61% gain, and the panic year that year was 1965, so holding all the way through 1965 would have yielded more than twice the return, 132%, and then not buying back in 4 years later, opportunity cost only 15%. It's pretty good. Holding for 3 years, it's a 23% modest gain. And then not buying in 6 years later, that's a 24% downside. So it would have protected you a little bit, 24%, right? That was also the time during great inflation. So 1978 would have been the next buy signal, and we would have saved ourselves about 24% or so. Buying in 1978, selling in 1980, that would have been a 62% gain, but if had we held on till the panic year, 1981, it would have been a 49% gain, so a little bit lower. And then from 1981 to 1985, 4 years, the markets did push higher, 29%. So that's the opportunity cost there. And then for 4 years of our holding, buying and selling, 124%. That's more than doubling in about 4 years. And then not buying back in 7 years, literally doing nothing but sitting out the market 7 years. From 1989 to 1996, that would have been a 66% opportunity cost for us by simply sitting out. But once we did get back in, the buy signal in 1996 to 1999, of course, the markets absolutely got crazy during that time. It was a dot-com bubble, 148%. And these are the two big signals that really mattered, and it came through. And that was sitting out from 1999 to 2005. Those 6 years were critical because we had the dot-com bubble burst. And this opportunity cost does not do justice to how bad the situation got. I'm simply calculating the difference between 1999 and 2005, and it's only 18% because the markets had recovered from its lows from the dot-com bubble. But of course, getting out in 1999 would have saved you thousands and thousands. In terms of percentage-wise, I mean 70-80%. That's how bad the markets were back then because we dropped after the dot-com bubble burst. And getting back in 2005, and guess what? Selling 2 years later, 2007, we're just getting out, and that's a 30% return. And then sitting out for another 5 years, not doing anything from 2007 to 2012, and that's a negative 24%. 24% return. So of course, once again, it's kind of underscoring the fact that 2007, 2008, the great financial crisis was pretty brutal. Markets were down 50% and they had recovered quite a bit until 2012. And that's why it's not doing justice to how bad the markets were. It's only showing negative 24%, but it was a lot worse. So these two times it absolutely would have pulled you out at the right time. Both in 1999 and 2007 were the good sell signals there. And investing back in 2012 till 2016, 62%, but had we held on till 2019, it would have been 153% return. And of course, now we are at 2023. And the good thing is that 2019, that was the last sell signal, last panic. Since then, we've had the COVID crisis and the markets have literally gone nowhere, and the opportunity cost was 18%. 4 years. 18%. In fact, I was talking about this yesterday in our Discord, that in the last 2 years, the markets have literally gone nowhere. It's just sideways, right? So there's not been any returns. So whether you invested in the markets or you're not invested in the markets, it doesn't really matter, right? But this Benner cycle would have pulled you out in 2019, and it would not have been until 2023 that we would have considered getting back in to the market. Now, these are all question marks, of course. We'll find out what happens because the next sell signal comes out in 2026. The buy signal, of course, is 2023, which is the year that we're currently in. So we'll see, what the next 3 years have in store for us. But what's interesting is that in this entire Benner cycle, had you precisely followed what this has to say, the success rate is pretty darn good, right? So we are looking at pretty good returns every single time when it comes to buy and sell. And the panic years also are almost always triple digit, except for once in the 1978 and 1980s when, of course, there was great inflation. That's only a 49% gain in about 3 years, which is also not bad if you consider what was going on back then, but 110%. Now, another thing that I want to point out is that we cannot underscore the opportunity cost. Yes, a couple times it pulled you out at the right time. It pulled you out right before the dot-com bubble burst. It pulled you out right before the great financial crisis. But some of these are pretty terrible. I mean, 61% opportunity cost, 66% opportunity cost, and that really adds on. And what I've done here is that instead of this sort of timing mechanism of using the Benner cycle and kind of buying in and out and using these years as any type of prediction, what if you simply bought in 1924 and didn't sell until 2023? That's a good 99 years. What would your return look like? And what I've taken is that I've taken a compounded annual growth rate of about 7.5%. That's about the average the market returns on a yearly basis. And I think it's fair to assume that in the last 99 years, the markets have returned at least 7.5%. Had you invested $10,000 back in 1924, your current portfolio would have been worth $12.8 million. This is not including dividends, simply taking into account a 7.5% return. And then, of course, using 99 years as a compounding mechanism, $10,000 turned into $12.8 million. Now, if you had precisely followed this strategy of buying and selling at different times, at different years, what do you think your return would have looked like? Better, the same, or worse? Pause this video. I want to know from you guys. So pause this video, and what do you think the return would have looked like had you timed the market like this, precisely following the Benner cycle, which has a pretty good success ratio? Do you think the return would have been the same, better, or worse from buying and holding? Pause this video. Let me know in the comment section down below, and be honest with yourself. The return would have actually been worse, much worse. What happened? Unhide. Oh no, wait. I gotta unhide this. There we go. All right, so the return would have unfortunately been much worse, because if you're following with the sell years, this is going to be sell years, and this is going to be panic years. Had you simply followed the sell years, it would have been a little bit under $1.4 million, and the panic years would have been over $913,000. Still great returns. I mean, from $10,000 to these numbers, but of course in a span of 99 years. But these were the final figures that I basically got after accounting for these percentages returned. And what I'm doing here for years, obviously I'm taking at the beginning of this year. So I'm taking January 1st, 2023 or January 1st, 1924. And for sell years, I'm taking towards the end, right? So I'm taking the end of those years. But the bottom line is, I mean, a buy and hold strategy would have clearly outperformed by 1.5 miles compared to this Benner cycle. But the thing with this is that, you know, obviously it would have pulled you out and would have saved you a lot of unrealized losses, because you've got to have the stomach to actually hold on to your portfolio when you've got, you know, 70-80% losses in the market, when you've got 1999 dot-com bubble bursting, 2007, you know, 1980s, the Great Depression. I mean, there's a lot of things that are included in these years. I mean, these years have a lot of history. So that's the entire analysis. Let me know your thoughts down in the comment section below. What do you think? But it is definitely quite interesting. And 2023 is here, which is considered as a year to be buying stocks according to Samuel Benner from 1870. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel. As always, happy investing. I'll see you all in the next video.